Now, hopefully you can see, let me zoom in a little bit more. You can see how they start coming together, okay? There's moving average moving like this moving average coming like that. It's crisscrossing, boom, 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 in and out. Okay, let's go back over here. Moving average moves like this. The other moving average comes up, crosses. It's weaving. Okay, now for all of you engineers listening, I don't want you sitting there thinking, well, is it better if it crosses 2 times or 3 times? Or what if it crosses 4 times? Okay, well, all we're doing here is we're looking for patterns. We're looking for likelihoods. Is it likely that the market is going to make a big move or not? Well, the likelihood goes up, and this is empirical for those engineers out there. But I have yet to see a move that was big. That's not the right way to say that. It happens a lot. Okay, let's just leave it at that. The weave happens a lot. And when you're looking for the highest probability types of trades, these are the ones that I like to take, where there's the weave. And that's the reason why. Because most of the large moves are going to come after you have the market compressing. I mean, look at this. You get the weave, plus you have this triangle forming. Okay, you get the weave, you have the flag. You get the weave, you have the flag. Okay, they go hand in hand. This one was very short, but you had a pennant pattern, or triangle pattern there. Right here. You got the weave and the pattern. So we're looking for this weave, or the sideways action, also consolidation. We're watching for the weave. People call it sideways, some people call it consolidation. All of it speaks the same thing, which is compression. The market is being squeezed. That's what we want. We want the market being squeezed. Now, the next basic element that we had was this whole idea. If you will remember, I called it the hand, right? Now, this is another word for isolated high, isolated low. And if you remember from the live event, I said, okay, put your hand in front of your face and make sure the market looks like that, where if you were to trace your hand, if you remember, I actually did trace my hand on the screen, it would look something like this. Okay, where you have your 2 fingers, your middle finger, index finger, and then finally your thumb. 2 highs, 1 big high, 2 highs. Now, it doesn't always look like this in the marketplace. Okay, you might have the market moving up like this, right, where it looks like the hand. You might also have the market where it looks like this. Okay, the market's moving up. You still have a hand there. As long as these 2 highs are lower than the middle, these 2 highs are lower than the middle, this is a hand. Okay, you could have something like this, where these 2 highs are basically even. These 2 are, one high is higher than the other, but all of them are lower than the middle. And the same thing would apply on the low side, where if the market's moving down, it may look like this, where these two lows are higher, and these 2 lows are higher. It could also look like this. Those are all valid hands. As long as the one in the middle is poking out, everything is as it should be. Okay, so we have the hand and we have the weave. Very important that you understand that.